In this presentation, we will work a problem related to a capital project, working the internal rate of return and the net present value types of calculations. The information will be up top. We're going to enter that information down below in the blue areas. Information up top, we're going to have a update equipment or replace equipment type of question. In other words, should we fix the equipment or should we just replace the equipment? We're going to want an internal rate of return or rate of return on investment of 12% in order to accept a particular course of action. If we fix the old equipment, it will last for 5 years. So we're going to say, all right, we could fix the old equipment and we think it'll last for another 5 years if we do so. The cost of the old equipment was $121,000. Cost to fix the old equipment is going to be $157,000. Annual expected revenues, if we do so, $91,000. Annual cash operating costs is going to be the $37,000. And then the salvage value at the end of the 5-year time period is going to be $22,000. Or, second option, sell the equipment and purchase a new one. We're going to sell the old equipment, purchase new equipment. That's the other option we can do. Cost of the new equipment costs $292,000. Cash received for the old equipment. In other words, we can sell the old equipment or scrap it or do whatever we need to do with it to get, and we can get salvage value of the $31,000. Annual expected revenue, $116,000, and the annual operating costs then are going to be the $27,000. The salvage value of the new equipment being $15,000. So first we'll present value, and what we're going to do is we're going to break this out and a per year by per year. So we're not going to be looking at an annuity and then the present value of one. We're going to do what I would assume to do, or I would expect to do, or what I would recommend doing for longer term projects, and that would be to actually get the cash flows as best we can for each year and then present value each year. So to do that, we're going to say here's the number of years. We're going to say the years are going to be 0, start at 0, 1, 2, 3, 4, 5. We need year 0 because year 0 is going to be when we actually have the initial investment. Then we can break out the cash flows in as many categories as we want. We could put them all into one column if we want. I like to break them out a little bit to give us a little bit more detail. First, we have the cost, which is going to be in year 0. So the cost I'm going to put in as a negative. So we'll say negative of the cost up top. If we're using option 1, the cost is going to be the $157,000. Notice what we're not taking into account. The original cost of the old equipment. We're looking at the cost to fix it, not the original cost. The original cost is sunk. It's not a question as of this point in time going forward because it's something that happened in the past. It's done. Nothing we can do about it. We're picking up the current information, the cost for the new equipment, or the cost in this case to fix the equipment. Then we're going to have the net cash flows. The net cash flows are going to be equal to, for the first item, it's going to be the revenues minus the cash inflows and the cash outflows. Now note, you could put this in 2 different columns, and cash inflows and outflows if you want. I'm going to net them out in the same column and enter. So there we have that. Now it's going to be the same for the 5 years. So not in year 0, but the 5 years. I'm going to do that by saying equals of the one above it, same number, and then autofill it down. So then I'll autofill it. You could also absolute reference these two if you want, and then autofill it down, otherwise to get this, the relative formulas to work on an autofill. And then we're going to go back down, and the salvage value is going to be equal to the cost at the end, which is $22,000. So there's the $22,000. Then we can sum this up. So this is going to be the totals for each year. The total per year in terms of cash flow equals the SUM, the sum of the cost, the net cash flow, and the salvage, and enter. We'll put our cursor there and then autofill that down. So we're going to say that we're going to autofill this down, summing this across. And therefore we have the relative formulas all the way down. Then we're going to take the present value each year. So we're just going to present value this each year, add up those present values. So we're going to say I'm going to say this one is just equal to the 157. No present value necessary because it's year 0. Therefore, it is what it is at this point in time. And then we're going to present value this one 1 year out. This is 1 year out. So we'll say negative present value, double clicking that item, and we'll take the 54,000. We'll take the rate, which is going to go up top, 12%. So that's what we're going to say the rate that we have to achieve is. That's going to be the rate of return on investment that is required. Therefore, if we use that rate then and we come up with a positive number, then we are getting the 12%. So 0 or above would mean that we are at the 12% requirement for the internal rate of return calculation. Comma, the number of periods is going to be 1. And then we're going to say comma, the payments is 0. So remember that's 0 because this is not an annuity. We're doing this 1 year at a time. And then we're going to say comma, and the future value is going to be this 54,000 1 year out. Now I'm going to do this a few more times, and then we'll use the autofill just so we get an idea of the calculation. So we're going to say this is negative present value, and we'll double click the present value. The rate is up top this time, 12%, and that's the rate that we need to clear for the internal rate of return in order to accept the project, comma, and then we're going to say the number of periods is going to be 2 now, comma, the payment is going to be 0, comma, and then the future value, the 54, and enter. So we'll do this a couple more times. Negative present value, double click the present value, rate is up top, 12%, comma, and then we're going to say the number of periods is going to be now 3 years out, comma, payment is going to be 0, comma, future value 54. So then negative present value, double click the present value, the rate is up top, is the 12%, comma. And then we're looking at the number of periods, which is 4, comma. And then we want the payment 0, comma, and 54,000. And one more time, negative present value, double click on it. Rate is up top, 12%, comma, number of periods 5, comma, payment 0, comma, future value 76,000, and enter. So there we have it. If we sum this up, we've got our present value there, which is the 50,141. 50,141. Now note, we could autofill as well. If I delete these items and autofill this down, notice I'm going to do it. It's not going to work if I do it this time, and I'll show you why. If I autofill it down, it doesn't quite do it right, and the reason is because now we have our rate up here that moved down. So we need to put an absolute reference for the rate, and then we can autofill it. So I'm going to delete this. I'm going to double click on this. This rate is in cell C3. So this C3 up top needs an absolute reference in order to autofill. So I'm going to F4 on the keyboard, put in a $sign before the C and a $sign before the 3, and then we can autofill, hopefully. So we'll select that and autofill that down. So there we have it, and it looks like it's doing everything as it should for our formulas. Now I'm just going to put the totals over here. I'm going to say total, and we'll total all the way across, sum the totals this way. Now note these totals aren't going to add up, of course, to the present value. So because these aren't present value totals, so you can't add it up this way because these are present value numbers. But we can have the totals in terms of cash flow by category in this format as well. And then we'll take a look at alternative 2. Before we do, however, just note that you can see that this number is above 0, obviously. So therefore, we have met and exceeded the internal rate of return. So this is higher than our required rate of return of the 12%. So that is acceptable. But now we want to, of course, compare it to the second option and see the totals and compare the totals between the two options to see which would be a better option to have. So now we're going to go to the option 2, which is going to have 0, 1, 2, 3, 4, and 5. We're going to have a total, and then we'll go through the same process. We're going to have the cost. I'm going to say negative of the cost for option 2, the cost of the new equipment for option 2, 292, and then we could sell the old equipment, and that would happen in the first or year 0 as well. So I'm going to say, all right, we could sell the old equipment and then get the salvage value of the old equipment, cash received for the old equipment. If we purchase the new one, maybe we can trade it in or something like that. So there we have that. And then we've got the net cash flows, which are going to be equal to the revenue minus the expenses. Enter. Now, last time we said equals the one up top and then auto-filled it down. The other way you could do it is you could absolute reference these two cells, absolute F4, F4, or a dollar sign before the B, a dollar sign before the number for each of them. And then you could go ahead and use the autofill it down, and it'll pick up the proper cells for that. Then we have the salvage value that we're going to get at the end of the time period. So we're going to sell the new equipment for the salvage value at the end of the 5 years, 15,000. And then we're going to just total this across to get the total cash flows per year equals the sum of, and we'll total this across. Then we'll autofill this down, and there's our totals. Now we can go ahead and present value these items in the same format. Remember, year 0, don't need any present value. It is what it is. Year 1, negative present value. Double click the present value. The rate is up top, 12%, comma. The number of periods, 1 this time, comma, 0, comma, future value, 89. And then we're going to say negative present value. Double click on this item, rate 12% up top, comma, and then we're going to pick up the number of periods, 2, comma, the payment, 0, comma, future value, 89,000, enter. Now, I could keep on doing this. Just remember that the 3 and 4 are going to change when we go to the next present value each time. What I'm going to do instead is just autofill this down. Remember that we're going to have to use the same absolute reference we did up top. So I'm going to delete this one, double click on this item. This rate, which is in cell C3, we want to make an absolute reference. So we're going to put our cursor on that C3, select F4 or put a dollar sign before the C and 3 and enter. Then we can autofill this down, and it'll pick up hopefully the correct numbers. It looks right because it's decreasing in value. Looks like it's picking up the right numbers. It looks good. Then we can sum these up, and there we have it. Now note, we did this 1 year at a time. You could also calculate these as an annuity and this as the present value of 1 if you think that's an easier way to do it. But this will give you more detail in any case. So I prefer doing it this way if we have the option, if we have Excel to do so. Then I'm going to sum these across just so we have the more detail, and I'm going to autofill that. This is the number we're looking for. So they're both clearing the internal rate of return of 12%. So they're both viable options given that restraint. So then the question is, which one should we do? And obviously alternative 2 is going to be the preferred option here. Also note, we can use Excel to calculate the internal rate of return, and in this format, when we think about the internal rate of return, we're not thinking about basically the rate to clear, because in this question, the question is, we want to make sure that we're clearing the 12%. In this case, we're going to say, what rate could we set this at in order for us to basically break even? What discount rate up top here, what internal rate of return would result in our present value being 0, in other words. So let's think about that. We could use a formula within Excel to do that types of calculation. We can say this equals the internal rate of return, and then we can highlight the total column. So this is the cash flows. So we're looking at the cash flows, not the present value. And I'm going to then make this a percent, home tab, numbers, percent. I'm going to add a couple decimals. And that means that this would be the internal rate of return. If in other words, we were to set this rate, the benchmark rate that we need to clear to be this, then our cash flow should be 0. Let's test it. So we'll go back up top. I'm going to say, what if I make this number equal to the 2363? What happens to our calculation? Because it's all formulas, notice it discounts it down to 0. So in other words, we could make our benchmark rate as high as this 2363, and this project would still be acceptable because a 0 means that we're clearing that basically discount rate item. So that's a useful calculation to have within Excel. To do it manually, to do that calculation manually is a little bit more difficult. It's nice to have this format set up so that we can then test that calculation as well with the use of formulas. We can do that same thing down here as well. So with this project, if I look at the cash flows and we said, all right, this is going to be equal to the internal rate of return, and highlight the cash flows for 0 through 5, and then make this a percent, home tab, numbers percent, add a few decimals, that would be at 21.9. So 21.9% as opposed to the 23.63. If we go back up top and say, okay, what if I made this equal to the 21.9, then we're going to say that this cash flow then goes down to 0. So that's going to be the rate at which the cash flow would then be down to 0 for the second alternative. So I'm going to undo that. And there we have that.